The Indian market opens weak but significantly recovers from lows. IT, autos, healthcare lead while banks continue to correct. Mid-caps too recover. The index trades in the green. On the macro front, it's the rupee that's a worry. It falls to a fresh live low, approaches the 82 per dollar mark.
And Torrent Pharma acquires cosmetic dermatology firm for around 2,000 crore rupees. The stock is lower by around 3%. The street believes the deal has been concluded at elevated valuations.
The Supriya Life Science stock too sulks in trade, down almost 5% as we speak after the CEO Shirish Ambaikar resigns due to personal reasons but will extend his services as a retainer for 2 years. New CEO Rajiv Kumar Jain takes charge from the 3rd of October.
Well, hello and welcome to Chartbusters. Well, it's another down day to kickstart trade. Though from the low point of the day, we've seen a good bounce. Close to around 100 points is what we have bounced off the low point. Though at higher levels, we are seeing some bit of supply that's creeping into our markets. The positive, though, is that the mid-cap index is well in the green. How do you trade the index from here on? Well, we have Shivangi Sarda, who joins in. Hi, Shivangi. Always good speaking to you, Shivangi. What's your call? You know, earlier today, if you were brave enough, and if you bought the first star low, well, you'll be quite happy. But what do you do from here? Do you believe the market's trying to form some sort of near-term base? Or do you think slippy slide, going back down towards that 16,500 odd mark?
Good morning, Nigel and Mangalam. Thank you for having me. So we've seen, the Nifty index has been in pressure from the last few sessions. But again, today from the lower zones, we've seen some sort of recovery and buying interest. But overall, if we look at the broader structure, it is still negative and it has to hold above 17,000 for some sort of strength and momentum in the plus side. But overall, it is still in pressure and we could see lower levels of 16,800, 16,666 zones. Now, the upside hurdle is placed at 17,166 zones. And looking at, Bank Nifty, the overall India mix is also very high. It's above 22 zones and which is giving somewhat comfort to the bears. And if we even look at the FII's figures, so they have turned negative, in this month. And we've seen the magnitude of selling has increased from the last, 2-3 sessions. And also the long short ratio has decreased to around 21%, which is quite concerning. So overall, the market will be in pressure. And looking at the banking index, it too, try to recover from its lower zones. But this bounce is expected, but it could see lower levels of 37,777 and a hurdle of 38,888 in Bank Nifty.
All right, we take that point. But individual stocks, we have a lot of pockets which are doing well. Pharmaceutical stocks are doing well. FMCG is at the high point of trade. A couple of these auto names. And now we have a bunch of these cement stocks bouncing back from lows as well. India Cements, for instance, is up around 5.5% from lows. Ramco Cement up 4%. Ultratech is among the top gainers from the lows on the Nifty right now. Currently at the high point with a gain of just about 0.5%. So, what are you doing with regards to individual stocks in the mid-cap, and are you looking to buy some given its outperformance?
So looking at, the entire structure, of course, FMCG and consumption stocks have been quite a lot in focus from the last few weeks. And the best part is that, it is resilient despite the market weakness. So one such stock which is on my radar is Asian Paint, and it is holding well on its daily and weekly frame. We've seen that weekly it's come out of its consolidation. And the good part is that we've seen good amount of rollover here, so which makes the stock very strong, and a slight recovery in the index would take this stock higher. So a recommendation on buy on Asian Paint with a target of 3,600 and a stop of 3,420. My second pick would be from the auto space, which is Escorts, and this stock is holding well above its 50 DEMA, and it took support yet again at these levels. We've seen 2 to 3 times in the last few weeks, and even on weekly frame, it is respecting 1950 zones. And if we look at the series on series basis, we've seen short covering move till now, and this should move and drive this stock higher to 2150 zones, and we could buy this stock with a stop loss of 2020.
All right, take that point, Shivangi. Thank you so much for joining in with your calls on the index and individual stocks. With that, we shift focus to a special segment where we get you a few ideas for profit coming in from our colleagues at Money Control Pro. And today we have Khushbu Gupta with a stock that she's been tracking.
So today we are going to talk about Seshafei Paper and Board, more commonly known as Sesha Papers. Sesha Papers is a well-managed and integrated player which weathered the COVID-19 storm by capitalizing on the changing industry dynamics. The industry is witnessing a paradigm shift from publication to packaging led by rising digitization, and the company is well placed with progressive volume growth and backward integration to meet the current surge in demand. Strong demand, good order flow, and margin recovery witnessed during the June quarter. This was made possible with the presence of synergies between the manufacturing facilities, coupled with benefits of the Mill Development Plan 3. We believe that the sector tailwinds, education reforms, and ban on single-use plastics could be key impact area for the industry. A comfortable liquidity position, coupled with debt-free balance sheet, will enable it to undertake new capex projects in the near future. All of these provide sufficient headroom for the growth visibility over the long run. The company is trading at 3.5 times EV by EBITDA and 6.6 times PE on FY24 earnings. The valuation is reasonable as there is pent-up demand for printing and writing papers. Also, the unprecedented rise in packaging board will boost earning visibility.
All right, Khushbu, thanks a lot for that. Well, time to slip into a short break. On the other side, we'll get chatting with the management of Mahindra Logistics on the back of their new acquisition. You stay with us.
Welcome back. Now, as promised, let's get chatting with the management of Mahindra Logistics. The stock is on our radar today. The company, remember, announced day before yesterday, post-market close, of an acquisition, the acquisition of the B2B business of logistics unicorn Rivigo for about 225 crores. What does this mean for them? The street would like to know the kind of revenue scale that they can bring and the kind of cost synergies that they can bring as well. The CEO, Ram Praveen Swaminathan, joins in to answer these questions for us and lots more. Thanks a lot, Ram. Always a pleasure speaking with you. And congratulations on the acquisition. And the first question really is that, as far as the acquisition is concerned, you've put in 225 crore rupees. The revenue of this business is 371 crores. Of the details that we have right now, this is a business which is operated out of a little over 1 million square feet of space. You at Mahindra Logistics manage almost 17 million square feet of space. So how much can you scale this 371 crores in terms of revenue to once Rivigo comes into your fold? How large can it be? And by when?
Yeah. So, with the proposed acquisition of Rivigo, our combined B2B express business, including what we operate today, will be in the 550 to 600 crore range, Mangalam. And what we are hoping, obviously, is to be able to grow this business at a high teen level. And our aspiration is to be in the 1,000 crore range over the next 3 to 4 years.
Okay.
So, and how much of that will be from Rivigo? How much of that will be yours?
No, it's a combination of the businesses. So we'll be combining both those businesses and operating it as one express business under the Rivigo by Mahindra Logistics brand.
As of now, what is the current revenue of your B2B business?
Our current business is around 180 crores
180,
on a trailing LTM basis.
Okay, all right. So around 550 crores, or you're saying it'll grow in high teens, and then in fact you raised around 1,000 crores in the next 4 years. Get that. What about the margin parameter, Ram? I'm looking at the consolidated entity, that's Rivigo. I think they had a negative margin of close to around 15 to around 20%. That's for the consolidated entity, but you have picked up only part of it. So for this business that you have acquired, what is the margin? Point number one. And point number two, you didn't think of buying the other part of the business?
Yeah, so I'll answer the second one first. I think expanding in B2B Express has been one of our strategic intents, Nigel, and we already have a large FTL business. So from day zero, our intent was only to look at the B2B Express business, but that was the strategic for us. In terms of financials, the business, of course, the B2B Express business is also losing money, not to the extent of the numbers you quoted for the overall company. But what we like about the business is revenue yield is very positive, and the business has positive unit economics. What the challenge has been to scale the business up. So we think the combination provides a significant fillip in terms of scale on day one, and further growth will allow us to gain higher scale. And we think over the next 3-4 years, it will be the gross margins of the EBITs of the business
When
will be
does
higher than that.
Ram, when does this business turn around? At what level, according to you? You're doing, the acquired business is around 370 crores. As you said, it's still not making money. So at what revenue number does that turn around? What's the plan you have for it?
Yeah, so our intent is to turn it around to be EPS accretive in the next 12 months on a combined basis. From a revenue yardstick, probably around 650 to 700 crores is where we think it'll essentially be EPS positive.
Right. A couple of bookkeeping questions. Are there any accumulated losses in the business that you acquired that can give you some sort of tax benefits? And what's the kind of goodwill that you will recognize of this 225 crores acquisitions that you've made?
Yeah, so as far as it's a business transfer arrangement. So essentially everything which is custodial to RSPL stays with them. We are not essentially taking any losses or any contingent liabilities or anything which is outside working capital right from the existing business from a PTL perspective. Right. As far as the goodwill is concerned, we are still closing structuring. So I think we'll be able to answer that specifically in the coming weeks.
So the reason I asked that is basically I just wanted to understand what the value of the net fixed assets that are coming to you on your books would be, and at the same time, is there any software that you get access to, proprietary platforms, etc., that may have worked for Rivigo and you can use it to Mahindra and synergize the other parts of your business as well?
Yeah. So what we are acquiring along with the entire PTL business, the customer contracts and the organization is a full technology stack, both B2B Express and FTL stacks of Rivigo and the Rivigo brand.
Okay. So you said you are acquiring some customers as well. Is there any overlap between their customers and yours, and anything that can give you an opportunity to upscale or upsell to those customers?
No, from an express perspective, the overlap in terms of customers is very small. Obviously, from an MLL perspective, there is an overlap because we serve those customers with other services as well. And so we think this actually is a great opportunity for us to increase share of wallet with those customers, leveraging a strong offering and our broader relationship with those clients.
All right. You're saying that from the last year, 370 crores, you're going to be looking at around 650 crores by when you believe that it will be EPS positive. To scale up the business, do you have to put in any more money, or it can be done with what you're getting currently?
Yeah, so the comparable number from a growth perspective, Nigel, will be 550 to 650.
Okay, the earlier financial year.
Yeah, so it will be the consolidation of both businesses. Right, and that is not going to require a significant amount of capital. We think the network is actually optimizable. We'll obviously have to invest in some working capital for volume.
And are there any thoughts on the payback period, etc., that you thought for of the 225 crores that you've invested? I mean, a rough back of the envelope calculation would suggest that at least 10% in terms of return is something that you should be looking at, to make good the cash that you've been expending on this acquisition. So, any sort of IRR or payback period analysis that you've done on this acquisition?
Yeah, so we model all our businesses to be about an 18% return on equity level from a medium to long-term perspective. That's the benchmark we use for our acquisitions and for most of our expansions. And I think this acquisition over a 5 to 7 year window will be able to exceed those guardrails.
Okay, all right. So we've spoken enough about this acquisition. Let's talk about business then. You have told us in the past that you want to go towards 10,000 crores odd. That's a great target, but in the near term, what are you going to grow by? FY23, what kind of a growth are you all aiming at? And give us a rough band in terms of margins.
Yes, I think, coming into the year, we obviously expected, to be growing at the 20 to 25% level on an overall company basis. And we still believe that that's something which we are aspiring to do this year. Different markets have moved a little bit sideways, but broadly, we still expect to be in range for that 20 to 25% kind of growth level. For F23. From a margin perspective, our long-term guidance or goal has been to increase gross margins by 30 to 50 pips annually. And most of that should kind of fall to the bottom line. So we expect that should happen this year as well. Right. These are, of course, numbers are excluding the impact of the Rivigo transaction.
Right. And, apart from the Revico transaction, you also announced the consolidation or restructuring of the Meru business into the enterprise mobility business. Just wanted to understand, the last time you joined us, you said the losses in Meru have declined from, 6 crores earlier to about 2 odd crores. What is the revenue that you're garnering from Meru right now? When does that turn profitable? What's the scalability plan there?
Yeah, so I think the business is moving well. Revenue growth and trip growth this year in this quarter is also up 30 to 40% compared to last year, right? And our enterprise mobility business is also recovering. A big lever for the profitability return, apart from volume, was really synergy on the supply chain and the assets, the fleets. So the announcement we made day before yesterday actually is an important step for us to allow the fleet to be more commonly utilized. We are pretty much on target. This year we've said that the combined businesses will be EBITDA positive, and we fully expect those to be EBITDA positive and comfortably so by the end of this financial.
Okay, all right. The final question, Ram, before we let you go. What's the outlook on last mile deliveries? I think it had moved from around, the target was that it moves higher. So what is it likely to be by the end of this year? And also give us a sense in terms of market share on the third-party basis.
Yeah, so I think if you look at the 3PL business, it's around it's $8 billion industry, and we are around 6 to 7% market share there. That market share is kind of broadly holding, right? As far as the last mile delivery business is concerned, we did announce and stake acquisition earlier this year with a company called Wizard or Ebitda Logistics, with an intent to go to majority position next year, right? So that business is growing well. It's a smaller business, but overall, our last mile delivery business, combining both what we do and what Wizard does, is in the 300 crore range, and it's growing at 20-25% this year. And obviously a big focus for us has been to drive profitability in that business as well. And so we are pretty much on plan to accomplish that, even as we're investing in capacity.
So the 10,000 crore target that you have in 4 to 5 years with regards to revenue, just wanted to understand how much of that would be organic, how much of that would be inorganic, because you all haven't shied away from making, acquisitions, etc., whenever necessary.
Yeah, so I think I'd rather define it as what we think is 3PL, what we think will be network services, and what will be mobility. And broadly, we hope that the ratio will be 60, 30, 10. Our core 3PL business will be 60%, the network services will be 30%, and mobility will be 10%. The acquisitions for us are a tactic and not a strategy. So when we feel that there is a need to accelerate the business faster in terms of capability and scale, and if we find targets, we'll actually make acquisitions. As I noted, this is our third acquisition in the last 12 months.
Right.
We have augmented the mobility business and the network services business, businesses for capability through.
And taking off from your margin expansion part and, interspersing it with your 10,000 crore revenue target, currently you do margins of just under 5% odd, expecting it to grow, maybe say in the next 4 to 5 years, your margins would be above that 7.5-8% mark. Is there a possibility? Ebitda margins?
Yeah, I think there's a possibility more than EBITDA to actually be at a 2 to 3% PAT.
Okay.
Obviously, EBITDAs are a function of leverage. So I'd rather just look at a PAT number. And I think we think there's a possibility to be the 2 to 3% PAT level.
All right.
Over the next 4, as we get scale and increased margins in some of these newer businesses.
Take that point, Ram. Thank you so much for joining in and explaining the path going forward, and congratulations once again on this acquisition. Hope it scales as you plan it to scale as well. With that, we take a short break, come back, get you more on the markets and individual stocks. Stay tuned.
Welcome back. Let's get straight to CNBC-TV18 exclusive. The Power Ministry has clarified to CNBC-TV18 that REC will continue to remain owned by PFC. This after the government rejected the proposal for Power Grid picking up a majority stake in REC. Abhimanyu Sharma, he spoke to the Union Power Minister, Mr. R.K. Singh, about the decision and why the proposal fell through. Let's hear out what he had to say.
We examined the whole issue. Basically, we find that the power grid is engaged in an entirely different business altogether, and they will have a controlling stake in a company which is engaged in the business of financing, about which power grid does not have any expertise whatsoever. So we thought about this matter, and we felt that perhaps this needs reconsideration. We've decided that we shall not go ahead with it.
So are you open to considering this proposal again? What are the challenges which you are possibly going to address in a fresh stakeholder consultation?
We are not open to considering this proposal again at all. I mean, we are very clear in our mind that we have decided against it, and that decision is final.
All right, so with that, what we do is come to an end of this edition of Chartbusters. You stay tuned. Trading Hour comes up next.